Anil Gupta, the CMD at KEI, joining in on the show right now. Anil, hi, good morning. Good to have you on the show. Despite the overall slowdown in the first quarter, you've managed to see revenues and segmental growth that was significantly better than the larger peers. Has the gradual pan-India expansion mitigated the impact of an infrastructure slowdown? Will this momentum sustain, you think?
We have a fairly good, strong order book position. And for the immediate future, our order book is around 4,500 crore, and which gives a clear-cut visibility to us for next 18 months. Even the order inflow every month is in excess of around 500 crore. So we are building up the order book, and we are confident that whatever guidance we have given, a growth of around 16 to 18% in this financial year should go. So far as impact of slowdown is concerned, we don't see a significant impact on it so far, because of the strong order book and diversified verticals and portfolios and demographics where we are working. I don't know whether we will witness some slowdown in retail sector in the next quarter, but this quarter until July we have not seen. We'll have to watch it out for next 6 months.
Gupta, let's also talk about your raw material costs, because copper, aluminium, all of that constitutes most of your expenses. Do you think that you'll be able to continue to pass on the increase in raw material prices? Do you think you're worried about it perhaps eating into your earnings?
Yeah, definitely. I have been maintaining that we always, the raw material costs increases are always passed through. But incidentally, in last 6 months, copper and aluminium has softened due to fall in LME. Albeit somewhat it is made up because of the increase in the exchange rate. But overall, it is still down. And but we are not impacted either way by this fall or increase in the copper or aluminium prices, because of our raw material booking policy with respect to our order booking.
EBITDA margins have improved on the back of a richer product mix as well as higher fixed cost absorption. Are you confident of sustaining margins at the current levels, given the strong order book position on EHV as well as on exports?
We had a EBITDA margin of around 10.55% in the Q1. So we had improved by around 0.8% compared to last financial year. And we are confident that we will be able to sustain this margin throughout the year, and while also improving our sales. Although we will still be looking for some improving these margins better, but our guidance will still remain at this level at the moment.
Now, when it comes to your branding and advertising as well, you're looking at a very aggressive strategy, the sponsorship for the India-West Indies tour. That's an expensive proposition. So what's the long-term strategy in place for your branding? Are you going to see these partnerships continuing?
We will continue to spend money on our branding, because we want to build up a strong brand among consumers. So while it is cricket or the other TV channels or below the line branding like in-shop brandings or outdoors, etc., we'll continue to do so, because that is our overall strategy to grow our retail and penetrate in smaller towns and rural. So at the moment, our retail sales are close to 34% of our total sales, and our aim is to take it up to 40% level of the total sales by next year. So this is our goal, and hence it is imperative to continue spend on the branding going forward.
44,300 crore rupees, Mr. Gupta, looks healthy apart from the EPC order received from Nepal. Which are the other orders in the pipeline, if you could highlight that? And what is the target on your order book now?
We expect to maintain a similar level of order booking, or to a maximum extent of 5,000 crore, so that we do not fall in our growth trajectory. While it is important that we are also increasing our capacities, we have already commenced the production at our new plant at Silvassa in Chinchpada for house wires and flexibles and other retail products. And we are also doing debottlenecking in our other HT cable and extra high voltage cable plants to grow the capacities by 10 to 15% by debottlenecking process. So it is important. We will continue to maintain a healthy order book position of close to 5,000 crore to maintain our sales and growth.
Okay, and your EPC sales, other than cable, have seen smart growth on the housing wire side. Affordable housing also seeing good traction. So do you think in light of that, your growth seems sustainable here? What can we expect for cable as well?
Actually, all the verticals had grown in the similar fashion, but we see a major growth coming out from cables and wires. We are witnessing a good growth in our wire segment as well from this affordable housing schemes of the government, and cables also are doing well either from the market or from our own EPC projects demands, and also the retail network. We expect that we should be able to maintain our growth in the coming years.
Phase 2 of the house wire capacity in Silvassa be completed by, and at full utilization, how much revenue would it generate?
We expect around 250 crore revenue from the new facility or new production facility in Silvassa in this financial year, because the facility is started only end of July, and it is still getting normalized. And also we expect 10% growth from our existing plants by improving the productivity and debottlenecking.
Also guided for about 18% growth in your revenues and EBITDA margins of close to 10.5 to 11% for FY20. Are you revising these targets, and what is going to drive your growth?
We are still maintaining our guidance of growth to maximum 18% in this financial year, and EBITDA guidance of around 10.5%. We are definitely trying to improve it to the level of 11%, and but the committed guidance, we definitely will go beyond 10.5% at the moment.
Great to have you on the show, Anil. Thanks so much for taking the time out and speaking with us today.